Accounting lessons, special accounts, joint venture. So in this introduction, we will see what is a joint venture. We will also get into some of the definitions of joint venture. We will briefly explain what the joint venture is from a special accounts perspective. So what is a joint venture? A joint venture is an association of persons for a defined period that is of short duration and is done for a particular venture or project in question. Now, persons or co-venturers come together and enter into a contract with each other where they decide upon each of their share of profit and their capital contribution. Sometimes there exists no agreement between co-venturers. In such a case, the profit and loss are shared equally by the participating persons in a joint venture. So this is the basics of what a joint venture is. Next, we'll see what is a joint venture agreement. It's an agreement between one or more persons. It's an agreement to carry on a specific job, project or venture. It's also an agreement which is over as soon as venture is over or complete, and it's a temporary partnership without the name of any firm. So that is what is a joint venture agreement. Now in a joint venture, cash basis accounting is followed, wherein the profit and loss is ascertained on completion of the venture. Now what is a cash basis accounting? Cash basis accounting is where revenues and expenses are recorded when cash is received or paid. What is the other method of accounting, which would be accrual basis, where revenue or expenses are recorded when it is earned. So in joint venture, cash basis accounting is actually followed. In a joint venture, the co-venturers contribute capital and share profit and loss at an agreed rate or ratio, where each co-venturers take part in the joint venture's management. So co-venturers are like partners, but not exactly partners. They contribute to capital and share profit and loss at an agreed rate or ratio, where each co-venturer takes part in the joint venture's management. It is also governed by Partnership Act because it is almost like a partnership which is joint venture. And in all respects, joint venture may be regarded as a temporary partnership. Also not the word, it is a temporary partnership. Now, what are the joint venture entries in accounting? There are three accounts which are maintained, which is joint bank, joint venture and co-venturer. Joint bank is a personal account, joint venture is a nominal account, and co-venturer is a personal account. Now we know the rules for each of the types of account. For a personal account, always debit the receiver and credit the giver. For real, debit what may come in and credit what goes out. For nominal, debit expenses or loss and credit incomes and gains. Now we will take a look at a joint venture where what each of these entries mean. For initial contribution made by co-venturers, joint bank account is debited and co-venturer is credited. Why is it so? This is because we debit the receiver, hence receiver is joint bank, and who is the giver here? It is the co-venturer. So co-venturer is credited. For expenses incurred from joint bank account, joint venturer account is debited and joint bank is credited. So joint venture being nominal account, expenses are debited and joint bank is the giver. Now, for assets brought in or expenses by co-venturers, joint venture account is debited and co-venturer is credited. All expenses in joint venture is debited and co-venturer is actually the giver. The reason why assets brought in or expenses by co-venturers, joint venture account is debited and co-venturer is credited. For cash sale, joint bank account is debited and joint venturer is credited. For taking over unused materials or assets by co-venturer account is debited and joint venture is credited. For sale of unused materials or assets as scrap, joint bank account is debited and joint venture is credited. For transfer of profit or loss on venture, so for profit, joint venture account is debited and co-venturer is credited. For loss, co-venturer is debited and joint venture account is credited. So for final settlement, what is done? If co-venturer account shows a credit balance because amount is paid to him, which actually means when does it show a credit balance and when does it show a debit balance? So if co-venturer account shows a credit balance, amount is paid to him, and if co-venturer account shows a debit balance, amount will have to be obtained from him. So that is the basic rules for the different entries we make in the accounts in the case of joint venture. Now there is an illustration given. We won't go through each and every statement of that illustration, but what we do is, see, there are two entities, A and B. These are two persons who entered into a joint venture and shared profit or loss in the ratio 3:2. So they opened a joint bank account where A deposited rupees 50,000 and B deposited rupees 40,000. A purchased goods for rupees 30,000 and incurred rupees 5,000 expenses out of joint bank account. A supplied materials out of his own stock for rupees 3,000, sold entire goods for rupees 50,000 and deposited that money to joint bank account. B, on the other hand, purchased goods for rupees 25,000, incurred rupees 3,000 for various expenses out of joint bank account. B sold all goods for rupees 44,000 and deposited money to joint bank account, but for goods valued at rupees 2,000 which he took for his own use. Write up joint venture account, joint bank account and co-venturer account. So this is the question for the illustration. We see that the total profit minus expenses would be the total profit which needs to be shared in a particular ratio. So here we won't go through the entire exercise. What we do is we just take part of it. Let us say A deposited rupees 50,000 and B rupees 40,000. We will see how it is recorded in the books. So here in this joint venture illustration, we record A deposited 50,000 and B deposited 40,000. So that will be shown on the debit side of the joint bank account. So here we actually say to A's contribution and B's contribution. A deposited 50,000 and B deposited 40,000. That will be shown also on the co-venturer's account, which is on the credit side by joint bank account. 50,000 from A and 40,000 from B. So remember, A's contribution will be shown on the joint bank account on the debit side for 50,000 and B's contribution 40,000. And on the co-venturer's account, on the credit side, A's contribution will be shown by joint bank, which is 50,000 and B's will be 40,000. Now the next one is A purchased goods for rupees 30,000 and incurred rupees 5,000 expenses out of joint bank account, where it has to be recorded. So A purchased goods for rupees 30,000. So that is recorded on the debit side of the joint venture account. And the expenses incurred is also recorded on the debit side of the joint venture to joint venture bank account purchase of goods expenses. The total amount is 35,000, which would be seen on the credit side of the joint bank account, rupees 35,000. And this is how you actually go on making entries. So when all entries are made, we can actually write up joint venture account, joint bank account and co-venturer account. Thanks.